In this section, we will be using cost information to make a make or buy decision, or it's sometimes called an outsourcing decision. In this scenario, a firm has to decide whether it's better to make a component of their main product themselves or to buy that component from an outside supplier. In this decision, revenues play no effect. This is all about saving costs. So, the decision rule for a make or buy decision is choose the option with the lowest relevant cost, subject to qualitative considerations. So, remember, one of our basic rules is that numbers advise us, but they don't rule us. So the first thing we do is look at how much does it cost to make the component, how much does it cost to buy the component, and then we think, is there any reason to choose differently? So for example, XYZ company has collected some data on a component that it needs to make its main product. The component has fixed and variable manufacturing costs and fixed and variable non-manufacturing costs. And the question is, given the fact that the firm needs 2,000 of these units each month, should it continue to make the component, or should it buy the component from an outside supplier for $11.50 per unit? In order to answer this question, we need to know not just what happens to the variable costs. Obviously, if we don't make the component, all of the variable cost associated with it will go away. But we also need to consider what happens to the fixed costs. It's possible that a decision to stop making this part would have no effect on the firm's fixed cost. In that case, those costs are not relevant for this decision because they would be the same whether we choose to make or to buy. In this particular case, however, we're told that the firm can save half of its fixed manufacturing costs as well as all of the variable manufacturing costs if it decides to buy the component. In real life, you'd have to go downstairs to the manufacturing supervisor and find out this information. However, in a homework assignment or a test question, that information must be given to you. We're also told that the firm's fixed non-manufacturing costs will not be affected by this decision. So that means those costs are not relevant. So the question is, should XYZ continue to make the part, or should they buy the part from an outside supplier? Well, let's take a look first at the status quo, that is what they're doing now, which is making the part. The information in the previous slide told us that our variable costs to make the part include $6 of variable manufacturing costs per unit and $1 of variable non-manufacturing costs. That brings the total variable cost up to $7 per unit. Since the firm needs 2,000 of these parts each period, they are spending $14,000 on variable costs to make the part. In addition, they have $15,000 of fixed manufacturing cost and $9,000 of fixed non-manufacturing costs for a total of $24,000. Obviously, if they make the part, they don't have to buy the part from an outside supplier, so their total cost is $38,000. What happens if they decide instead to buy the part? We're told they will have no variable costs. We're told that half of their fixed manufacturing costs will go away. Maybe because they don't need a building, or because they don't need machinery and the maintenance and the depreciation associated with that machinery. For whatever reason, their fixed manufacturing costs will be reduced from $15,000 to $7,500 per month, but their $9,000 non-manufacturing fixed cost will remain unchanged. So net, their fixed costs are reduced from $24,000 to $16,500. But the firm has to buy the components at $11.50 each. For 2,000 units, that's $23,000, bringing the total cost of buying the component to $39,500. So net, the cost to buy the component is actually $1,500 greater than the cost to make the component. So on the basis of dollars and dollars alone, the firm would choose to reject the offer to buy and would continue to make that component. Subject to qualitative considerations. For example, the firm may consider that if they buy the component from a company that specializes in making it, maybe the quality control would be better, and that would be worth an extra $1,500 to this company. Or they may consider that scheduling all of the production associated with making the component and then using it to make the main product is too complicated, and it might be worth $1,500 to them to simplify their production schedule. For whatever reason, knowing that it costs more for one alternative than another doesn't answer the question, what should we do? You still have to take all factors into consideration when you make a managerial decision. Now, what if that space that had formerly been used to make this component could be leased out to a tenant for $3,000 a month? How would that affect our analysis? Well, it wouldn't make any difference to the fixed and variable costs of making the part, but it represents an opportunity cost. That is, by choosing to continue to make the part, the firm has to give up $3,000 a month in rent. It can't rent out that space if it is using the space to make the component. Therefore, choosing to make the component actually costs the firm $41,000. Now, if we compare that to buying the component, Where there is no opportunity cost because we would be able to rent out that space, our total cost to buy is only $39,500. Thus, in this scenario, we actually save $1,500 by choosing to buy the component. So based on dollars and dollars alone, we would accept the offer from the supplier to buy these components for $11.50 each. But subject to qualitative considerations. For example, this analysis assumes that we'll be able to get a tenant for $3,000 a month for the unused space. If that's not true, then this analysis would be incorrect. Furthermore, maybe the tenant turns out to be a terrible nuisance and damages our building. We might consider that it's worth $15,000 to us simply to avoid that stress. In addition, anytime you turn over a function to somebody else, you turn their problems into your problems. If we outsource the manufacturing of this product and there's a labor strike at the supplier's business, we won't be able to get this part that we need. Or what if there's a UPS strike? Or what if the supplier raises its price right after we have given up our manufacturing capability? For all of these reasons, we might consider that it's still better to make the component, even though we know that it's going to cost us more. Now, there is another way to look at this particular analysis. Instead of treating that $3,000 as an additional cost of making the part, we could think of it as a reduction in the cost to buy the part. In that case, that $3,000 that we get from the tenant reduces the cost to buy. In this way of analyzing the situation, there is no opportunity cost to make the part, so our total cost is $38,000, and the $3,000 of rent reduces the cost to buy the component to $36,500. However, the difference is exactly the same. It costs less to buy than it does to make the component, subject to qualitative considerations. Let's try a practice problem. A firm needs 8,000 units of a component, and we have some information about the materials, the labor, the variable overhead, and the fixed overhead associated with manufacturing this part. We're also told that out of all of the fixed overhead, 25% of it would be avoidable if we choose not to make the component. An outside supplier has offered to sell us this part for $6.20 per unit. So the question is, should the firm make the part or should they buy the part instead? Let's take a look at how to analyze this problem. If we make the part, our costs will include $2 per unit for materials, $1.20 per unit for labor, and $1.50 per unit for our variable overhead. That's $4.70 per unit. At 8,000 units, that means our variable costs would equal $37,600. In addition, we have to incur $18,000 of fixed overhead, bringing the total to $55,600. What happens if we buy the part? Well, we don't have to pay for any of the variable costs. Instead, we have to pay $6.20 per unit times 8,000 units. And we have to pay 3/4 of the fixed overhead because we were told that 25% was avoidable. That means 75% is not avoidable. Add that together, the total cost is $63,100. So net, the difference is $7,500 less to make the part rather than to buy the part. So this decision, whether to make or buy something, really involves two processes. The first process is determining what the dollars are telling us, which option costs less, and then thinking, is there any reason that we would want to choose differently?